So, if trading can be learned, then why do so many traders struggle? Here's the thing. Technicals are easy to learn. Every single person can learn technical trading, right? Technically proficient and psychologically a mess. That's what most people are. They learn all the great technical strategies, they learn everything, but their head is not right. Psychologically, they're a mess. So most traders achieve technical proficiency pretty quickly. They get skilled at recognizing chart patterns. They're able to pick the market direction with great accuracy. We see on social media all the time people saying, hey, I called the top here, I called the bottom here. And I'm not saying that they didn't. Maybe they did. They're great at picking patterns and they're great at picking directions, but still they can't make any money trading. Why is that? The reason for that is psychology. Our brain is our worst enemy at times. It could be your best friend too, but for a lot of people, it's the worst enemy. 95% of trading is psychological. The idiot inside all of us, right? Between our ears, there's an idiot. There's a monkey inside everybody's head. Now, when we trade, sometimes that monkey comes out and he starts trading on our behalf. It happens to every single one of us. It's happened to every single one of us, including me. So we need to control that idiot inside of us. We need to control and overcome our demons. We need to know what to do, right? And a lot of people, what happens with them is they know the right thing to do. They know they should be getting out of that loser. They know they should not add to a losing position. They know they should hold their winners longer. They know that. They know what the right thing to do is, but they still don't do it, right? And a lot of people, it's like, do as I say, but not as I do. So there are so many people out there that are excellent at telling others how to trade. I mean, just go on Google. There's thousands of trading education companies teaching people how to trade. But yet, they can't trade themselves, right? Yet they can't produce results. So they're excellent at telling others how to trade, but they can't heed their own advice. That's what you got to do, right? So here's a nice little quote here again. I trust everyone. It's the devil inside them that I don't trust. So again, why do so many people struggle? Trading is a challenging endeavor. It is not a get-rich-quick type of business, and it usually takes time to learn how to make money. Unfortunately, most aspiring traders enter this industry thinking, oh, it can't be that hard. I can easily do this. And they immediately make a lot of money in a very short amount of time. And what happens, this is extremely naive. And we see that all the time. You go on Google, you will see these adverts saying, hey, learn how to make $1 million from home. Or how a guy turned, $5,000 into $1 million, right? How a guy took $7,000, turned it into $25 million trading the Forex markets. And what happens is that gives everybody a bad reliability, right? It gives them a bad expectation that all the trades are going to work. They're going to start making money suddenly. And that's the wrong approach to take in trading. It's not a get-rich-quick scheme. It is a business, right? When you start a business, unless, you were Mark Zuckerberg, which is pretty rare, businesses take time. And trading is a business. When you start trading, you are starting a business. You are the CEO of your own company. If your name's John, you're the CEO of John's Trading LLC, right? You are the CEO of your trading business. And what happens, most people just jump in expecting to get rich quick. And this is mainly the fault of a lot of marketers. You see all these penny stock guys, Forex guys promoting how you can make tons of money really quick. But that is a wrong approach, okay? So from my experience, it generally takes traders about 2 to 3 times longer than they think to succeed. And this isn't to say that some people don't pick up on the business very quickly, but this is the exception, not the rule, okay? The problem with this is that most people think they will be the exception. I mean, which is fine. It's always good to expect that you're going to make it. It's always good to expect that you're going to be the one who defies the rule, but you still have to be realistic so as not to be disappointed if it does end up taking some time. So, that's one of the main reasons so many people struggle and ultimately fail, because their timeline for success is too near. Okay? So to be successful, you have to work hard, be tremendously objective with yourself, and most importantly, choose a trading style that is conducive to your personality. And I'll make it clear, I love day trading stocks, right? But when it comes to Forex trading, I prefer more longer term approach. 1 hour chart, 4 hour charts, daily charts. I like holding stuff for more than a day on Forex, but that might not be your style. You might not be a patient trader, so you might prefer trading on a smaller time frame. You might prefer day trading Forex, right? And for some people, you don't have time to day trade all day. You just want to take a couple positions and manage them. So for you, swing trading might more be the approach. So you have to choose a trading style that is conducive to your personality. And a lot of traders, what they try and do is they copy someone else's style, which is fine. It's always good to learn from people. But if your personality is more, nervous and jittery and, seeking instant gratification, then, swing trading is not the approach for you. It takes time, right? But maybe you are more patient. You don't want to just, get in and out of trades. And for swing trading might be more for you. So while there's some things you can emulate, your main approach to trading has to come from within your personality, which you will only truly learn in the trenches of the market, which comes from experience of taking many trades. This is the single biggest reason that traders struggle. They fail to realize that successful trading is simply a matter of managing emotions and then letting the odds play out. My goal and our goal here at Live Traders is to be transparent while helping educate traders on the proper technical chart patterns as well as the proper mental approach to the business. We understand that there are a lot of different ways to succeed, and we will examine many of those styles throughout this course. But we also understand that ours is not the only approach to trading. So we try to stay open-minded and flexible because we are always learning and striving to be even better. We will also make it our main objective to show the importance of money management, trade management, and of course, the role that psychology plays in being an effective trader. We have found many trading education firms place far too much emphasis on chart patterns alone, when in reality, the chart patterns are much less important than having proper psychology, money management, and of course, market experience, which we believe is the single most important factor to success. Now, as we go through this course, please pay attention to not only the slides, but what I am saying, right? As my words are coming from years of real live trading experience. This course is not being taught by an armchair warrior. It is being taught by a true professional that have earned their place in the markets. Though that might sound conventional, in truth, it is very uncommon in the trading world. Now, let's get started with the basics. So what is Forex? Everyone is at different levels, so let's bring everyone on the same page. So Forex is the buying and selling of currencies, okay? Long means you're buying a currency expecting it to go higher, okay? That is mean going long, or it's also known as being bullish on a trade, all right? And short is basically you're betting against the prices to go down. That is being bearish on the trade. Now, Forex is mainly considered a OTC or interbank fully electronic market. It does not have like a centralized exchange. Like, when you're trading US stocks, we have the NASDAQ stock exchange, we have the New York stock exchange. Forex is fully electronic and there's no centralized exchange, okay? So in the whole, Forex is a zero-sum game. What does it mean by a zero-sum game? What it basically means is that when you're buying, there's someone on the other side selling it to you. When you're selling, there's someone on the other side buying it from you. So there's only two things that can happen. Either he's right or either you're right, right? So it's a zero-sum game. For every winner, there's a loser. For every loser, there's a winner. So you have to ask yourself the question, who's on the other end, right? That will give you an edge. So in the Forex markets as a whole, US dollar is the king of the market. That is the actively traded, most frequently traded currency. Now you can see here the currency composition of the world Forex reserves. The whole Forex trading, 62% of the trading involves the US dollar, 28% involves some other currencies, 4% the pound, and you got the Japanese yen, the euro. So basically the major currency pairs are the US dollar, Great Britain pound, the Japanese yen, and the euro, okay? The Forex market landscape. So the market closest to the ideal of perfect competition. Now, Forex is the biggest market that exists. The average daily turnover, the market estimated at $4.5 trillion. You can combine all the stock markets, and they still would not be as big as the Forex markets. You can literally take all the US stocks, add them together, they will still be somewhere in the billions, right? Whereas the Forex markets are at a trillion, and it's grown approximately 20% as of 2007. Okay, so the banks that do the most trading, Deutsche Bank does about 18.6% of the whole market share. UBS accounts for about 11.3%. Barclays in the UK accounts for about 11%. They're the biggest ranking banks, followed closely by Citigroup, Royal Bank of Scotland, JP Morgan, HSBC. These are the big banks. These are the big players, okay? And you can see here, the US dollar accounts for 84.9% of trading volume. Euro accounts for 39.1%. Japanese yen 19%, pound 12.9%, Australian dollar 7.6%, so on and so forth. So these are the major currency pairs here, the first four, okay? The Forex market time zones. So when does the Forex market open? So Forex markets are open from Monday to Friday. Now, in practical application, right, they're actually open 24/7. I mean, Forex is currencies. Currencies don't stop trading, right? If you're traveling to another country, you're going to buy currency, right? And you can always buy it, even on a Sunday, even on a Saturday. But most brokers close on a Saturday just to, kind of accept the close of the day, make the reports. So from our trading purposes, markets are open from Sunday to Friday, right? Sunday, 5:30 a.m. Eastern Time, 5 a.m. Eastern Time is when the markets will open on a Sunday in the evening, and then it'll close on Friday evening at 5:30 p.m. Eastern, okay? So again, when do the Forex markets open? Sunday, 5:30 p.m. Eastern, and then they'll close on the Friday. That's the Forex market. So you can see here, you can always check out the Forex time zones, the first sessions, second sessions, and third sessions. And let's take a look. So, in a nutshell, the Forex market is a seamless 24-hour market and is open 5 days a week. At 5 p.m. Sunday, New York time, Eastern time is when trading begins, and the market opens in Sydney and Singapore. At 7 p.m., the Tokyo market opens, right? When the Japanese, in Japan, when the market opened at 7 p.m., which is on the Eastern time. Then at 2 a.m. Eastern time, the London market opens. And then finally, New York opens at 8 a.m. And you can see that again here, right? 8 a.m., the New York market opens. So when you're trading from 8 a.m. till later, right, that is the New York session, okay? So we can see here, again, at 7 p.m. the Tokyo market opens, followed by London at 2 a.m., and finally New York at 8 a.m. Now, as a trader, this allows you to react to favorable, unfavorable news by trading immediately. Now, here's the difference between stocks and Forex. When you're trading stocks, right, the stock market opens every day at 9:30 a.m. Eastern time, and it closes at 4 p.m. Eastern. So let's say there's some news out on your particular favorite stock at 5 p.m. Eastern, and you want to trade it. You can't, right? I mean, in theory, after hours you can, but the markets are closed. So that's the basic difference. Let's say there's news out at 9 in the evening about your stock, that it's going bankrupt. Guess what? You can't do anything. You can do nothing. You have to wait till the morning until market opens again, right? Whereas with Forex, the markets open 24 hours. So if you want to take a position in the middle of the night, you can do that. That's the benefit of trading Forex, okay? Now, Forex trading takes place all over the world, is not located in any central location. As I covered, you can trade from anywhere in the world, and deals are done between a variety of traders, from banks to managed funds to individual traders, okay? So we take a look at here again. So who trades Forex, right? The major market participants in the Forex markets are the reserve banks, the governments, large mutual funds, banks, companies, hedge funds, and individual traders. And you can even add individual people. And you might ask, well, individual people don't trade Forex. My dad doesn't trade Forex. My mom doesn't trade Forex. Well, think again. They do. They have traded it before, and so have you. Even if you've not put on a single Forex trade yet, you've still traded Forex. How is that? Well, when you travel to another country, right? Let's say you live in the United States. You want to travel now to visit London for a holiday. Well, you're not taking your US dollars, right? You're probably converting your US dollars into the Great British Pound. Or maybe you're taking your US dollars and from the airport, you get that changed into the British Pound. So what are you doing? What you're basically doing is you're selling your US dollars and you're buying the pound. So you just put on a trade. Congratulations. So, why trade Forex? What's the benefits of trading Forex? The benefits, as we covered, is that the Forex markets are a 24-hour market. The currency market operates 24 hours a day, 5 days a week. It doesn't open and close each day like the stock market, which means prices can fluctuate smoothly all week. Stocks, on the other hand, are subject to gapping when the market opens each morning. For example, if bad news comes out after the closing bell on a previous day, this can cause big problems if the market gaps in the opposite direction to your trade, which, it's hard for us to predict our risk because, we don't know where it's going to gap to. Whereas with the Forex markets, it's much easier to manage your risk, right? And in Forex markets, no one can control the price. What does that mean? Well, let's take a look. The Forex markets are so big that no single entity can control the price. Whereas certain stocks, on the other hand, are small enough that the prices can easily be manipulated by groups or even individuals, right? We've seen a lot of these, articles that published online or, these penny stock traders. They themselves can move the stock by buying large quantities or by getting their subscribers to buy a large quantity. But with Forex markets, no individual or no single entity can influence the price. So if you've seen, movies like Wolf of Wall Street, you may be aware of the pump and dump scheme. This is where a group of traders and brokerage firms will send out a strong buy alert to their clients, which artificially inflates the price and only to dump their own stock at their, at the peak for a huge profit, sending prices back down to the determinant of their clients' trading accounts. This simply cannot happen and will not happen in Forex because Forex markets are so big. I can go in the Forex markets right now and buy $1 million worth of currency. And guess what's going to happen? I'm not going to be able to move the price even a little pip. Whereas if I was trading a stock and it's a thin stock and I go in and buy right now $1 million worth of that stock, I could move the price myself. So that's the benefit. Now, Forex is also the lowest cost in the industry. Right? Forex has some of the lowest transaction costs in the entire financial market. The commission structure in Forex changed in early 2015, which made it even cheaper for swing traders like us to do business. A typical $1,000 swing trade on the Euro US dollar, might cost about 10 cents per round trip, or might cost you $1, maybe 10 cents, right? As opposed to costing you maybe $5, $10, $15 in trading stocks, right? So the transaction cost spreads are dynamic, meaning they change throughout the trading day depending on volume. Later in the course, we will also show you exact time of day, which is the best to trade depending on your strategy. Now, another benefit of the Forex markets is the high leverage. But before we get into that point, I want to recap the point about lowest cost, because when you're trading stocks, especially day trading stocks, you have to pay a platform fee, right? Your platforms might cost $100, $200, $300 a month. Whereas with Forex, most brokers, all the platforms that they provide are free of cost. You don't have to pay a monthly amount. That's another benefit. Another benefit of trading Forex is the high leverage. When you're trading stocks, your broker will only give you 2-to-1 if you want to hold overnight. Or they might give you 4-to-1, right? If you're trading, day trading. Even if you go with a big prop firm, they might give you 10-to-1 or 30-to-1. Whereas with Forex, the leverage you can get can go up to 1,000-to-1. Some brokers give 50-to-1, 100-to-1. If you are outside the US, you can get 200-to-1, 500-to-1, even 1,000-to-1, right? Because currencies usually only fluctuate by a cent or so each day. So to make a substantial amount of money, you need to place thousands of dollars on each trade. Luckily, the brokers recognize that not everyone starts with a huge trading account. So they allow you to leverage your positions. We'll explain leverage in more detail in the section later. Also, another benefit of Forex is the high liquidity. To purchase any investment or any trade, remember, there has to be someone willing to sell that opportunity to you at the same time. Now, with stock, what happens is you want to, let's say, buy a stock, but there's not many shares available. Let's say you want to buy 1 million shares of, let's just say, GoPro. You can't just go out right now and hit an order to buy 1 million shares, right? Because you're going to move the market against you and you're going to buy at a pretty bad price. Also, some stocks are perhaps not liquid. You want to get out, but you can't. There's no buyers. So Forex markets, there's high liquidity. To purchase any investment or to any trade, to enter that, there has to be someone willing to sell the opportunity to you. See, the advantage of Forex is due to the sheer size, there's always someone willing to buy or sell and trade with you. This is even more crucial when you're looking to exit a trade and need to get out quickly. In the stock market, you can often get stuck in a trade that is turning sour with nobody willing to take it off your hands. All right, another thing. You can make money when the market is falling. Unlike the traditional investment model of buy low, sell high, the Forex market offers traders the option to short a currency pair and make the money on the fall. So you can actually bet against any currency pair. You can even do that with stocks. However, with some stocks, you cannot. You need a lot of money to short stocks. Maybe some short stocks are not available to short. Whereas with Forex, you can short a currency pair no problem and bet on the downside of the currency pair. If you're bearish on, let's say, London, right? If you're bearish on the United Kingdom, you think United Kingdom economy is not doing great, their currency is going to fall, you can actually bet against that and profit from that. Okay? In fact, some of my trading students and I recorded one of the most profitable trading periods during the start of global financial crisis in 2008 as we shorted the market.